Okay, this is Clay Nichols, and I'll be doing an analysis of the stock Bery, B-E-R-Y, um, and they make packaging and containers for other businesses. Okay, so let's go take a look at the Zacks report. Let's see, they have a good description of the company. Manufacturing distributes non-woven specialty materials. In other words, paper and boxes. Based in Evanston, Indiana. So it's essentially consumer packaging, or that's a large part of it, and engineer materials and hygiene products, etc. Boring company. I love these kinds of companies. So let's take a look. It's was and this information is about 5 days old. It's down about 5% in the last year, but looks like it's flattening. Let's take a look at this. So you can see the price there down, well, mostly down this year, I would say, actually. It's down 5% compared to the full year, but it's down from a high of about 75 to about 55. So down about 30% or so. Okay. Analysts are accurate 100% of the time. This is really critical. I try to only look at companies where the analysts are accurate because everything's based on earnings. And if they've been accurate before, the analysts are likely to be accurate again. Past performance is indicative of future performance. Okay. They're 60% undervalued according to Simply Wall Street, trading at 62% below their fair value, earnings forecasted to grow, and earnings grew this year. Debt's not well covered by operating cash flow. I'm not too worried about that, especially, yeah. Now, Zacks does show them as a hold. I won't go into that, but suffice it to say, Zacks.com ranks them a hold. I'm not a huge fan of just following the Zacks ranking blindly, because if you look here in Zacks, it's rated A for value, F for momentum. I'm not too worried about momentum. I'd rather get in a little bit early and catch the bottom than buy it I'd rather buy it on the way down than the way up. Assuming, of course, it eventually goes back up. And growth is only a C. I don't know that I agree with that, and we'll see why. Okay. So earnings growth is 15 to 18% per year. 1 year is about 15 to 34%. WallStreet Zoen shows us projections out anywhere from 1 year of 35%. The average is 35%. So the low is almost flat for earnings growth. Revenue's a similar picture, but the lower estimates are a little bit down. And the average 1 year growth is 35%, average 2 years, 48, which ends up being about 25% in that second year. So that all looks really good to me. Fastgraphs, let's jump over to Fastgraphs and actually look at them. So Bery, okay. I won't go into how Fastgraphs works. I have another video on that. Suffice it to say, the historic PE for this company is around normal is about 15. Now, if their PEG were 1, PE to growth ratio were equal to their earnings per share growth, or a PEG of 1, which is one way of valuing current earnings and future, they'd actually be at 45. So really, we'd almost expect them to almost get back to the orange line. But I tend to be conservative, and whichever the line is lower, orange or blue, I go with that one. So if all they do is come back to their historic PE range and everything else, the company performs as expected, and remember, the analysts were accurate 100%, then we'd expect them to return 72%. Now that is the stock return. Now see, the earnings are growing, and we'd expect actually, let me go adjust this. This is probably a little bit better. So we come back to this 15.3%. Let's double check this. So historic is 15.3. So if they return to a 15.3%, which is up here, we'd be looking at total annual rate of return of 70%. That's including dividends. Oh, it doesn't have a dividend. Okay, great. So we're looking at an expected return, optimistic return of 70%. Let's see. Simply Wall Street. Now let's go back to, we were talking about earnings per share growth. So we're thinking it was 15 to 18% per year. WallStreet Zoen pegs it a much higher than that. Fastgraphs pegs it at about 15%, as we saw there, 15 point something. Simply Wall Street reports it at 9%. Now that's over the next several years. And our return on investment is, we're looking at 9 to 42%, depending on whether, again, it returns to its historic PE, or if it maintains its current PE, we would expect to get roughly the earnings per share growth, which is about 15%. In other words, it maintains the same PE, but the earnings go up, so the price goes up commensurate. Still not a bad return. So I consider this a value stock with a lot of upside potential. Risks, inflation. They're selling B2B, so it may be hard to raise prices. However, I think that it would have already been impacted already because commodity prices have gone up or seem to have gone up. So they've already suffered through that, and they still grew earnings. So inflation might actually help them if it gives them an opportunity to raise their own prices, but it is a big question mark. So I am looking at buying. Well, I've already bought this. I bought it in the dip. I bought it around here, and then it went up slightly. And I actually, yeah, bought it in this little dip. I think it's going to flatten now and start rising at some point. It certainly seems to be undervalued. So that's where I'm at. So I'm a buy and a relatively long time hold. Buy at about 56, and probably if it goes above, look here, if it goes above about 125, I would probably sell, because then it'll probably be overvalued. And we can look at Fastgraphs for that. So this price, if it gets up to 124, or if it gets up to, in the next, by the third quarter of this year, it gets up to 111. If it goes above this orange line, I'm typically going to sell, because then it looks like it's overvalued, and I've had good success with Fastgraphs in that. So I'd love to hear your feedback. Anything you think I've missed. I'd rather be smart. I'd rather be right than feel smart. Thanks. Have a great day.